Hello and welcome to this session in which we will discuss auditing, dividend, and retained earnings. We are still working within the capital acquisition and repayment cycle, and specifically within this equation, assets equal to liabilities plus equity. So we finance the company through two sources: debt, which is liabilities, and we went over the liabilities cycle and we finished this one. Now we are finishing equity. What we're left with is dividend and retained earnings. So we will discuss what's dividend, what's retained earning, and how do we audit these two accounts. Starting with dividends. Dividends are paid out of retained earnings, are paid to shareholders. This is why you invest in a company. You invest in a company because the company will generate revenues and it will incur expenses, and after that they will have a profit or net income. This net income here, part of it will be paid out to investors in form of dividends. So when we keep the profit that we keep is called retained earnings. So dividend is paid out of retained earning. It's a way of saying thank you for investing in us. It's for the owners to reward themselves. They take some of the profit in form of dividend. And this distribution occurs usually quarterly for small companies or in the real world, but for publicly traded companies, they usually pay them out quarterly, which is 4 times a year. So in this session, we will discuss those. But think of the dividend as sharing a slice of the company's success with everyone who owns the stock. Because you're the owner, now you want to pay yourself out of the profit. So we would dive first into discussing dividend. How do we audit dividend? And as we are done with auditing dividend, we will talk about retained earnings. Dividend is part of retained earnings. So in a sense, we are auditing part of retained earnings by auditing dividends. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here.
The first thing I want you to know about auditing dividends is they are audited 100%. We don't sample. We usually audit everything. Why? Because there are few transactions when we are dealing especially with small companies. And there are few transactions because we don't pay dividend on a weekly basis. We pay dividend quarterly. For some companies could be semi-annually, but the norm is quarterly. So we don't pay dividend every week. Most of them are quarterly. There are a handful of transactions per year. Now, although there are a handful of transactions, you might have many people getting money, but nevertheless, we're going to see how it differs between private and public. Material impact. Each transaction can be large, making it too risky to skip any. So you cannot skip any. And complete auditing ensures nothing is missed because the number of transactions is small. Completeness is important. Let me talk real quick about private versus public. If it's a private company, you might have few or a limited number of owners. If it's a private company, few transactions and limited number of owners. So it's a small amount of owners and few transactions. For public companies, you could have millions of owners, but you'd have a third party maintaining that number, but few transactions. So that's why you can audit every single transaction. So what are the key audit objectives for dividend? One is, did the dividend actually happen? Occurrence. Did they actually pay the dividend? 2, did they pay it for the right amount? That's what we want to know. Accuracy. Those two together, getting occurrence and accuracy right, is important because this makes sure there are no phantom transactions. What's the risk? And here we're dealing with private companies. The risk is someone at this private company taking money out in form of dividend or not taking money and we recorded it as dividend. We want to make sure that the transaction did occur and it's occurred properly, so no one is over or underpaid. Existence. Did the recipient really owns the share? because we want to know if you're paying to someone that individual actually owns the share, specifically on the record's date. Because when it comes to dividend, we have 3 dates that are important. We have the declaration date, which is the date that the company declared the dividend. We have the record date, and this is important. This is the date that we determine whether an individual owns the stock or not. And we obviously have the payment date. This is the day that we actually make the payment out. But what's important is on the record date, that this individual actually exist in a sense of owning the stock. And if they exist, we pay them. Now, dividend payable, if the dividend hasn't been paid, is the liability properly recorded? And when do we record the dividend payable? At the declaration date. And when do we remove it? At the payment date. So real quick, the journal entries are as follows. When you declare the dividend, you debit retained earning, you credit dividend payable, this account. Then you have the record date where you determine who you are going to be paying. Then on the payment date, you debit dividend payable and you credit cash. So those are the entries that are involved. 3 dates and 2 entries, because on the records date there's no entry on the records date. You just confirm that this individual actually exists. And the other thing we want to make sure, completeness, were all dividend recorded or did some go missing? Now, I told you what we need to be aware of. How do we make sure we are aware of accuracy, existence, completeness, occurrence? Very easy. The evidence is all coming basically from the board of directors. Remember, dividend is a major transaction. Reviewing board of directors minute for dividend authorization. First, did the board authorize it? Because if this group does not say it's okay to pay dividend, we don't pay dividend. We also check for unrecorded dividend that might be declared before year end. We want to make sure that if they okayed it, it might be a liability first. Make sure that liability is recorded. Remember, once we declared it, it becomes a liability. 2, we want to make sure that the amount match the declaration, accuracy. Now, how do we make sure it's accurate? We perform few computation. Take the number of dividend times the payment rate, which is 50 cents, 75 cents per share. How many shares are outstanding? Accuracy. Include dividend payable as part of the liability. So these steps help the auditor confirm that all obligation on the books and nothing has been left out. The key is the board of director meeting. How do you verify accuracy? Well, how can the auditor make sure that we are paying the right people? We math and verification. Recalculate the total dividend, multiply the number of outstanding shares by the dividend per share. Now, if a transfer agent exists, and this is public companies, they handle the payment. Auditor just checks the agent record against the company record. It's very easy because you assume they're doing a good job. You assume they're keeping track of it. And records companies, that's all what they do. They keep track of who owns the stock. How about if the company don't use a transferred agent? And here we're talking about private small companies. You have to do internal dividend audit verification. What do you have to do? You have to take a recorded dividend payment from the cash disbursement journal, we paid it, find the correspondent canceled checks, confirm check was issued to the shareholder of record as listed on the official date. So we made the payment to the person that actually was on the date of record. Cross-check the amount with the dividend declaration. Okay, they own 100 shares times $1. We pay them $100. Is it $100? Ensure all payments match official record and there's no double dipping. We only pay them once, not more than once. And this process works best with a few big transactions. No need to sample like you might do with thousands of transactions. So for small private companies, this is how you will internally audit this account. Pretty straightforward. Let's take a look at this multiple choice question from farhatlectures.com. In determining whether the presentation and disclosure related objective for capital stock activities are satisfied, the auditor would examine what? So here we're looking at disclosure. So the disclosure, what would the disclosure include? It will include many things. But part of the disclosure, you need to show the par value, how many stocks are issued and outstanding, any general rules about the equity section. Do we review the minutes for the shareholders meeting, the corporate charter, the auditor's analysis of dividend transaction, the shareholder capital stock master file. Let's eliminate the easy answer choices here and focus on the challenging one. And the reason I say this, because there are two options here that you should be able to eliminate easily, and two options you want to be careful how we are going to analyze. Let's start with the shareholder capital stock master file. This shows you what? Detailed record of individual shareholders, name, addresses. That has nothing to do with the audit objective of disclosure. Actually, if anything, you want to keep those private. So D is an easy elimination. The auditor analysis of dividend transaction. When you analyze dividend transaction, you're analyzing it not for the presentation. You want to see if there's anything unusual, any amount that's unusual. But it has nothing to do with what do you need to disclose. You're analyzing just to see if the amount are kind of correct, maybe for accuracy. So it has nothing to do with disclosure. Then we have two more options, and those are the minutes of shareholders meeting and the corporate charter. And the reason I said you have to be careful here, because every time I talked about capital stock disclosure, I said the minutes are important. Yes, the minutes are important. But here you are looking at the disclosure related objective. In what sense? For example, you want to disclose the number of shares outstanding. That's important. You want to know the voting rights of the shareholders. That's important. You want to tell them about the dividend preference. Those are important for the shareholder. Those are important disclosure in a sense that everyone will have to know every time, constantly. Now, where would you look for this? Would you look in the minutes of the shareholders meeting, or you would look at the corporate charter? I would say here the corporate charter will give you the basic information about the shareholders, about the shares, not the shareholders, the shares. As a shareholder, you are interested in knowing what's your voting right. What is your right as a shareholder? What's your liquidation preference? And those are in the permanent corporate charter. The minutes of the shareholders, they will tell you what? They will tell you activities that's taking place now. It is helpful, but really the basic information is listed in the corporate charter. For example, the par value, you don't find this in the minutes of the shareholder meeting, because once the par value is set, it's set once, it's set in the corporate charter. So this is really a bit challenging, but I would say the corporate charter is where you need to look for the basic disclosure. Is there other things that you can use for disclosure? Yes, but the basic is the corporate charter. What should you do now? Whether you are an accounting student, a CPA exam candidate, you want to go to Farhat Lectures, look at additional resources, whether you are studying for a professional certification, trying to do well in your course. The best investment you can make is invest in yourself. Good luck, study hard, and of course, stay safe.